Hours in the recording, right? Perfect. Perfect. Good. Speaker notes. Yep. Minute. Alrighty, we will get this started. Hello, everyone. Welcome back to another Beta Alpha Psi meeting. Today, we will be talking about tax preparation workshop. Yes, tax season is right around the corner, and April 16th is tax day. So we figured, why don't we help you, our members, prepare your taxes this upcoming tax season. So before we go into the meat of tax, let's talk about first what is tax preparation. So tax preparation is the process of preparing and filing tax returns to comply with tax laws and regulations. It involves collecting and organizing financial information such as income and expenses to determine the amount of tax owed or the amount of refund due. Tax preparation can be done by the taxpayers themselves, basically anybody, including yourself, or it can be using a software like TurboTax. I know I think for my internship, I did it with them. We used, I think Volker's, I think that or Engagement, I think we used, or hiring a professional tax preparer like an accounting firm. And the goal of tax preparation is to ensure that the taxpayer pays the correct amount of tax, no more and no less, and takes advantage of any tax benefits for which they're eligible. So when I mean no more, no less, like right down to the cent, perfect. Cannot make one mistake. So why should you prepare your taxes? Well, first off, you have to comply with the law. Preparing and filing your taxes is a legal requirement in most countries, and here in the United States, it is a requirement. And failure to do so can result in fines or even criminal charges. You do not want anyone to endure that. So word of the wise, file your taxes when they are due. Second, you have to make sure you have accurate calculation of tax liability. So tax preparation helps you determine the correct amount of tax you owe or the amount of refund you are due. Now, this helps you avoid overpaying or underpaying taxes, which can result in fines or having to pay back the money owed to the government. You're also able to maximize your tax benefits. So preparing your taxes, it allows you to take advantage of the tax benefits, such as, for example, deductions and credits, which can reduce your tax liability. By preparing your taxes, you can ensure that you are taking the fullest advantage of all the tax benefits for which you are eligible for. You're also able to get an improved financial planning. Preparing your taxes, it gives you a better understanding of your financial situation, including your income, your expenses. This information can be used to improve your financial planning and make informed decisions about your financial future. And last, peace of mind. Preparing your taxes, I know it seems like a lot, but trust me, at the end of the day, it'll be all worth it. You have that peace of mind knowing, okay, I filed my taxes for this year. I don't have to worry until next year. So what do you need to start to file your taxes? Well, first, you're going to need your personal information. So I think this is kind of obvious. Full name, social security number, and contact info. Now, if you are married and file jointly, you'll need the same information for your spouse. Income information. So this includes W-2 forms from your employer, 1099 forms for any other income sources, such as freelance work or rental property income. and any other documentation of income received during the tax year. You also need to get your expense information. Now, this includes receipts and records of expenses related to your job or business, such as, for example, travel supplies and business-related meals. You also need information about other expenses, such as charitable donations, mortgage interest, and medical expenses. Tax forms. Depending on your situation, you may need to use different tax forms. And trust me, we are going to be going over all of them, so that way you know which tax forms you need to fill out. So, for example, if you are an employee, you'll need to file a Form 1040. If you're self-employed, you may need to use a Schedule C. And then receipts and documentation. So you should keep your receipts and other documentation of expenses that you want to claim as deductions. And back in the day, people would usually, and I can actually attest to this from my parents, that they actually would hold all the receipts. And I always ask them, like, why would you keep all the receipts? Why don't you just throw them out? It's like, well, you know, you're able to save money on your taxes. I'm like, oh. And then when I learned about it, I'm like, oh, that actually makes sense now. And again, this will help to ensure that you have the necessary information to support your deductions when preparing your taxes. And then bank and investment statements. So you'll need to provide information about your bank and investment accounts, such as interest and dividend income, capital gains and losses, and contributions to retirement accounts. And finally, tax preparation software or a tax professional. Now, you can have them done by a software, for example, TurboTax, or by a tax professional, an accounting firm. So these are the types of tax forms. There are many, 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 many types, but just Cliff Notes version of it. Here are basically the ones that we will be going over. Form 1040, 1099, Form 1120, Schedules A through F, Form W2, a Form W9, and a Form 4868, and that is only when you are requesting for an extension. So let's start off with the most common one, the 1040. This is the standard tax form used by individual taxpayers to report their income and calculate the federal income tax liability. Now, what I'm about to say are some key points to consider when completing your 1040. Like, first off, your personal information. Oh, sorry about that. I thought I had a question in the chat. You'll need to provide your name, social security number, and other personal information on your 1040. Now, for your income, you'll need to report all sources of income, including wages, salaries, tips, and other taxable compensation. Plus, you will also need to report interest, dividends, and other investment income, as well as any taxable refunds, credits, or offsets. Now, the adjustments to income. So the Form 1040, it allows you to make certain adjustments to your income, such as contributions to a traditional IRA or a student loan interest. These adjustments can reduce your taxable income and lower your overall tax liability. Itemized deductions. Now, if you choose to itemize your deductions, which you can, you don't have to, but if you want to, you'll need to report expenses such as medical and dental expenses, state and local taxes, and even mortgage interest. Itemizing your deductions may result in a lower tax bill than claiming the standard deduction. And there's also the exemptions that you could claim. You can claim an exemption for yourself and any dependents you may have. Now, each exemption reduces your taxable income by a set amount. Now, basically, to calculate your tax liability, after you reported all your income and made any adjustments, you'll use information on Form 1040 to calculate your tax liability. Now, this really involves using the tax tables or a tax calculation worksheet to determine the amount of tax you are owed, and then to make a payment. If you're owed taxes, you'll need to make a payment to the IRS. You can make it payment by mail, electronically, or through tax professional. And filing your 1040, once you complete it, make any necessary payments, you'll need to file your return to the IRS. You can file electronically or by mail, like I stated earlier, and you'll receive a confirmation once your return has been accepted. So going now over to the 1099. So the Form 1099 is a tax form used to report certain types of income that are not reported on your W-2 form. And basically the types of income used to report on the 1099, which include interest, dividends, rental income, and income from independent contracts. Now, who does issue these 1099s? These are usually issued by the entity that pays you the income. Now, this could be, for example, a bank, brokerage firm, a client, or landlord. Now, the deadline for issuing a Form 1099 is usually January 31st, following the year in which the income was received. So, now you're probably wondering, well, what do I require to report if I am given Form 1099? If you are given that, you'll need to report the income on your tax return. That means you'll need to keep track of all your Form 1099s and include the information on your tax returns. And I will probably stress this every single slide if through this presentation, but accurate information. All the information you put on your tax returns, they have to be accurate. You cannot lie. Don't lie. It is important to make sure the information is accurate. If there's a mistake, you'll need to contact the issuer and have them correct it. So my advice is double check your work. Believe me, it can save you. And if for some chance you fail to report your 1099, you may be subject to penalties or interest charges. And in all honesty, you really should just keep a copy of all your Form 1099s in case you need to refer in the future. So now we'll talk about Form 1120. So Form 1120 is a standard tax form used by corporations to report their income and calculate their federal income tax liability. So the purpose of, we already talked about that already. So for business information, you'll need to provide information about the corporation, its name, taxpayer identification number, so its EIN, and the dates of its tax year. You'll also need to report your corporation's gross receipts, sales, as well as any other income received. And if your corporation is involved in the sale of goods, you'll need to report the cost of goods sold as well. On top of that, you'll also need to report all your corporation's deductions, including business expenses, depreciation, and contributions to employee benefit plans, or EBPs as short. And your corporation might be eligible for certain tax credits, such as the research and development credit, R&D credit, the low income housing credit, and others. Now, after you reported all your corporation's income and deductions, you'll use that information in Form 1120 to calculate your tax liability. This will involve using tax tables or a tax calculation worksheet to determine the amount of tax you owe. And if your corporation does own taxes, you'll need to make a payment to the IRS. You can make it, again, by mail, electronically, or via tax professional. And once you please, yep. All right, and I will pass it off to Gloria to talk about the Schedule A, B, and C.
Talking about, it should be Schedule A first, okay. Schedule A is a tax form used to itemize deductions for individuals who choose to take advantage of this option instead of taking the standard deduction. Some of the important points to consider when completing Schedule A is the purpose. Schedule A is used to itemize your deductions, which can include charitable contributions, state and local taxes, mortgage interest, and medical expenses, among others. Also, as well as eligibility, in order to itemize your deductions, you must have sufficient itemized deductions that exceed the standard deduction amount. The charitable contributions, you can deduct charitable contributions that you made during the tax year. This includes the cash donations as well as contributions of property such as clothing, household goods, or vehicles. The state and local taxes, you can deduct state and local income sales and property taxes that you paid during the tax year. Also, the mortgage interest, you own a home, you can deduct the mortgage interest that you paid during the tax year. In terms of medical expenses, you can deduct medical and dental expenses that you paid during the tax year as long as they exceed 7.5% of your adjusted gross income. Limitations, in terms of limitations, there are limits on the amount of some itemized deductions that you can claim, such as a cap on the amount of state and local taxes that you can deduct. You should keep records of all of your itemized deductions, including receipts, canceled checks, and other documentation in case you are audited by the IRS. Also, when choosing between itemizing and taking the standard deduction, you need to compare your itemized deductions to the standard deduction to determine which option provides the greatest tax benefit. If you can go down, Schedule B. For the Schedule B, is a tax form used to report interest and dividend income for individuals. And some of the important points to consider when completing your Schedule B is the purpose. Schedule B is used to report the interest and dividend income that we received during the tax year. This includes interest from saving accounts, bonds, and other investments, as well as dividends from stocks and mutual funds. If you have a foreign bank account or investment, you might be required to report the interest and dividends received from those accounts on your Schedule B. You only need to report interest and dividend income if the total amount received during the tax year is over 1,500, and most interest income is taxable, although there are a few exceptions, such as interest from tax-free bonds. The qualified dividends are taxed at a lower rate than the ordinary ones, so it's important to know the difference between the two. And you should keep records of all of your interest and dividend income, including the 1099 forms and other documentation in case you're audited by the IRS. And if you have a foreign bank account, you may need to file a separate tax form such as Form 114 FBIR to report the account to the IRS. The Schedule C is a tax form which is used by the self-employed individuals to report their business income and expenses. And some important points that we need to consider when we complete Schedule C is also the purpose and this Schedule C is used to report the profit or loss from a sole proprietorship or single member LLC. This includes the income from freelance work, consulting, or any other self-employed activity. And to be eligible to file Schedule C, we must have a trade or business in which we are self-employed, and we must have received income from that business during the tax year. You'll need to report all of the income that you receive from your self-employment activity on your Schedule C. This also includes income from sales, fees, and commissions. We can deduct expenses that are necessary and ordinary for our trade or business. This includes items such as supplies, utilities, rent, and advertising. Also, we can claim depreciation on business assets, such as equipment, vehicles, and property. And if we use a portion of our home for a business that we have, we might be able to claim a home office deduction. We should keep records of all of our business income and expenses, including the receipts, invoices, and bank statements, in case we are audited by the IRS. And after we subtract our business expenses from the business income, we need to calculate the net profit or loss, which will also be reported on Schedule C. And for the self-employment tax, if we have a net profit from the business, we need to pay self-employment tax, which will cover our Social Security and Medicare taxes.
Schedule D. So Schedule D is a tax form which is used to report capital gains and losses from the sales of investments such as stocks, bonds, and mutual funds. Some important points to consider when completing Schedule D is a Schedule D is used to report capital gains and losses from the sales of investments. That includes, like I said, stocks, bonds, and mutual funds. The tax treatment of capital gains depends on how long you held the investment before selling it. Short-term capital gains, which are from investments held for 1 year or less, are taxed as ordinary income. Long-term capital gains, which are investments held for more than a year, are taxed at a lower rate. You will also need to report all of your capital gains and losses on a Schedule D, including the date of purchase, the date of sale, and the sale price. The cost basis of an investment is the original price that you paid for it, plus any other costs such as commissions and fees. You'll need to calculate the cost basis in order to determine your capital gain or loss. The wash sale rule disallows a loss on the sale of a security if the same security is purchased within 30 days before or after the sale. If you have both capital gains and losses, you need to net them together to determine your overall capital gain or loss tax for the entire year. Capital gains are taxed at different rates depending on your tax bracket and the type of investment. It's important to be aware of those different tax rates when determining your tax liability. And you should also keep your records of all your capital gains and losses, including brokerage and statements of other documentation, in case you might get audited by the IRS. Schedule E, which is a tax form which is used to report income or loss from several rental properties, royalties, or passive activities. This includes rental income from real estate, income from limited partnerships, and income from passive business activities. If you receive a rental income from a property, you will need to report this income on the Schedule E. You will also need to report any expenses related to the property, such as property management fees, insurance, repairs, and depreciation. If you receive income from royalties, such as from a patent or copyright, that also gets reported on the Schedule E. If you have income from a passive business activity, such as an investment in a limited partnership, that also goes on a Schedule E. If you have a loss from a passive activity, such as a rental property, you may be limited in the amount of loss that you can claim depending on your level of involvement in that activity. If you have a rental property, you also need to calculate the depreciation of the property and report that on your Schedule E. And you should keep records of all your rental income and expenses, as well as records of any passive business activities in case you are audited by the IRS. Schedule F, that's a tax form used to report income and expenses from farming activities such as raising livestock, growing crops, and other agricultural activities. If you have income from farming activities, this goes on Schedule F. This includes income from the sale of crops, livestock, and other agricultural products. You will also need to report any expenses related to your farming activities on Schedule F, such as feed and seed costs, labor, and machinery expenses. If you have machinery or equipment used in your farming activities, you may be able to claim depreciation on those, which would reduce your tax liability. You should also keep record of all your farming income and expenses, including receipts in case you're audited by the IRS. And there is a special tax rule for farmers, which allows them to give the special deductions, such as deductions for farm machinery and equipment and the Section 179 expense election. It is important to be aware of these rules and deductions when preparing your tax return.
All right, now I'm going to talk about what Form W-2 is. So Form W-2 is a tax form used to report wages and salary income to employees and the IRS. So reporting wages. So again, the Form W-2 reports the total amount of wages and salaries paid to the employee during the year, as well as any federal, state, and local taxes withheld from the employer's pay. It also reports the amount of Social Security and Medicare taxes withheld from the employer's pay during that year. Now, if the employee participated in a retirement plan, such as for example, a 401k or a pension plan, the amount of contributions made by the employee and the employer during the year will be reported on the Form W-2. And it may also report other deductions taken from the employee's pay, such as pre-tax health, insurance contributions, flexible spending, account contributions, and wage garnishments. And it is very important to verify the information on your Form W-2 is accurate. Make sure you have your name, your social security number, and wage and tax information. And if there's any errors, most likely you should contact your employer to have these errors corrected. And you'll need your Form W-2 when preparing your tax returns. So again, as the information on there is used to calculate your federal and state income tax liability. And then going to Form W-9. So unlike Form W-2, Form W-9 is used by individuals or business to provide their taxpayers their identification numbers, or TIN, and certifications to requesters such as banks or payers of income. So Form W-9 requires you to provide your TIN, your taxpayer identification number, which can be your social security number if you're an individual, or if you're an employer, it'll be your EIN if you're a business. Now, this does include certifications that you are not subject to backup withholdings, and yet you are a U.S. person, or in other words, a U.S. citizen. It is important to carefully read and understand the certifications before signing Form W-9. Now, if you are a sole proprietor or a single member LLC, you should provide your social security number on that form. On the other side of that coin, if you are a partnership or disregarded entity, you should provide your employer's identification number on there. And if you are a corporation, you should provide your employer's identification number. So mainly what I'm saying here, if you are a partnership, disregarded entity, or a corporation, you most likely have to require your EIN. If you are a sole proprietor, just your social security number. Now, the requester must use the information provided on the Form W-9 to prepare an accurate information return, such as Form 1099 MICS, which is miscellaneous. If the requester knowledgeably uses incorrect information, they may be subject to penalties. All right, I know that was a lot of forms we have to go over. So now let's know about your filing status. So your filing status is a very important factor in determining your tax liability and the tax forms that you will need to use. There are 5 different filing statuses to choose for when you're paying your tax, and we did talk about a couple of them. So let's go more in deep now. So single, I think this is obvious. One person, single person. If you are not married and do not have a qualifying dependent, you basically file as a single taxpayer. Married, filing jointly. So if you are married, you and your spouse can choose to file a joint tax return. This often results in a lower tax liability and can simplify the tax preparation process. And then you have married filing separately. you and your spouse could also choose to file separate tax returns. This can be a good option if, and only if, one spouse has a larger amount of income or deductions. And then you have the head of household. If you are unmarried and have a qualified dependent, such as, for example, a child, you may be able to file as the head of household. This status often results in a lower tax liability than filing as a single. And then qualifying widower or the dependent child. If you're a widow or a widower with a dependent child, you may be able to use this filing status for 2 years after the year in which your spouse passed away. Now, it is very important to carefully consider your filing status when preparing your taxes, as it can have a significant impact on your tax liability. If you're unsure which status to choose from, consider speaking to a tax professional. So now let's talk about deciding when to file. So the deadline, obviously, for all federal tax returns is April 15th, otherwise known as tax day. However, there are several factors to consider when deciding when to file your taxes. There is the availability of forms information. If you're waiting for certain forms or information to be sent to you, such as, for example, if I am an employee of a company, I am waiting then to get my W-2. It may take sense to wait until you have everything you need before filing your taxes. And let's say, for example, if you are due a refund, there is no advantage to filing your taxes earlier rather than later. However, if you owe taxes, it may be helpful to file as soon as possible to avoid interest and penalties. Life change. So if you've experienced a life change, like, for example, getting married, having a child, or buying a house, it may be helpful to speak with a tax professional before filing your taxes. And if you're self-employed, you may need additional time to gather the information and complete your tax return. And if you cannot make the tax day deadline, you can always request a tax extension, which can give you an additional 6 months to file your return. However, this extension only applies to the filing of the return and not to the payment of any taxes owed. So now let's talk about knowing what is tax deductible, because not everything is tax deductible. There are certain things that are, and there are other things that are not. So again, it is very important to know which expenses are tax deductible. And tax deductions are expenses that can be subtracted from your taxable income, reducing your overall tax liability. Now, some common tax deductions, which I have included right up here, are the following: medical and dental expenses. You can deduct medical and dental expenses that exceed 7.5% of your AGI. And AGI, that stands for adjusted gross income. There's also charitable contributions. You can deduct this made to qualified charitable organizations, such as, for example, a church, a nonprofit organization, or a school. Example, FDU. State and local taxes. You can deduct state and local income, sales, and property taxes up to a limit of $10,000. $5,000 if married and filing separately. Home mortgage interest. You can deduct interest paid on a mortgage for your primary residence up to a limit of $750,000. That's literally $750,000. $375,000 if married and filing separately. Investment interest. You can deduct investment interest paid on loans used to purchase taxable investments, such as, for example, stocks and bonds. Retirement contributions. You can deduct contributions made to a traditional IRA up to a limit of $6,000. Now, if you're 50 years or older, $7,000, as well as contributions to other types of retirement account, like we talked about earlier, 401k and an SEP IRA. Job-related expenses. You can also deduct certain job-related expenses, such as travel, supplies, and business-related meals. And then casualty and theft losses. You can actually deduct those losses caused by a natural disaster, such as a hurricane or an earthquake. Now, again, it is important to know that these are just a few examples of tax deductible expenses. There are many, 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 many more, and we're not going to bore you on all of them, but we give you just some of the most popular ones that are out there in the tax world. All right, let's now talk about understand the tax break. So tax breaks, also known as tax incentives or tax credits, are special provisions in the tax code that allow you to reduce your tax liability. Tax breaks can be in the form of deductions, like we talked about earlier, credits, or exemptions, and they are available for a wide range of expenses and activities, including some of the following we have here. I'm not going to go over the ones that we already talked about, but I will talk about some that we did not talk about. So for example, we'll talk about mortgage interest. If you own a home, you can deduct the interest paid on your mortgage. Education expenses. You may be eligible for a tax credit or deduction for education expenses such as tuition and fees, textbooks, and even student loan interest. Energy efficient home improvements, going solar, going green. You may be able to take a tax credit for making energy efficient upgrades to your home, like buying a solar panel for your roof. That can be put as a tax break. Child and dependent care expenses. You may be able to take a tax credit for expenses relating for caring for a child or dependent. And then adoption expenses. You may be able to take a tax credit for expenses relating to adopting a child. So again, these are just a few examples, but it's very important to carefully review the tax code and see and make sure you know which one that you're able to do for a tax break. Gloria, that's you.
In terms of knowing unusual tax deduction rules, while many tax deductions are well known, there are some unusual tax deductions that you might not be aware of. And some of the examples of unusual tax deductions that you might be able to claim are the home office expenses. For example, if you use a portion of your home exclusively for business purposes, you may be able to deduct a portion of your mortgage interest, property taxes, insurance, utilities, and other expenses. Also, the job hunting expenses. If you're looking for a new job in your current occupation, you may be able to deduct expenses related to your job search, such as resume preparation, travel, and employment agency fees. If you move due to a change in your job or business location, you may be able to deduct certain expenses related to the move, such as the cost of transportation and the temporary living expenses. If you live in a state that imposes a tax on personal property, such as a tax on vehicles, you may be able to deduct that tax on your federal tax return. And if you suffer a loss due to theft, natural disaster, or other unexpected event, you may be able to deduct the amount of the loss, which is subject to certain limitations. And you can also get a jury duty pay, which means if your employer pays you while you're serving on a jury, you may be able to deduct the amount of the pay that you don't include in your income. If you have investment income, you may be able to deduct certain expenses related to managing your investments, such as investment counseling fees and safe deposit box rental fees. These are just few examples of the unusual tax deductions that you may be able to claim when preparing your taxes. However, it's important to keep in mind that the rules regarding the tax deductions can be complex, and you might need to provide documentation and meet certain eligibility requirements in order to claim a deduction. And if you're unsure about deduction, it's always a good idea to seek the advice of a tax professional or use the tax preparation software. So how to keep track of your spending? You can keep track of your spending throughout the year, which is a really important part of preparing for your taxes. Knowing that you accurately track your expenses can help you a lot to maximize your tax deductions and to reduce your taxable income. And some of the tips that you can use to keep track of your spending are to use a budgeting app or software. There are many apps and software programs that are available that can help you track your spending and as well categorize your expenses. You should keep receipts of all of your purchases and make sure you save the receipts for expenses that may be tax deductible, such as charitable donations, medical expenses, and job-related expenses. If you use a credit card for most of your purchases, you can use your credit card statements to track your spending and categorize your expenses. And it's really important to keep track of your mileage, meaning if you use your personal vehicle for business purposes, make sure to keep track of your mileage, as you may be able to deduct the cost of operating your vehicle on your tax return. And also keep track of your investment expenses. If you have investment income, make sure to keep track of any expenses related to managing your investments, such as investment counseling fees and safe deposit box rental fees. By keeping track of your spending throughout the year, you can ensure that you have all the information you need to prepare your taxes accurately and take advantage of all the available tax deductions. And additionally, having a clear picture of your spending can help you to make more informed decisions about your finances throughout the whole year. It's really important to keep accurate record as well, meaning that it's crucial when it comes to preparing your taxes. And there are several reasons why. One of them is evidence of the income and deductions, meaning the accurate record keeping provides you a lot of evidence of your income and deductions, which are all necessary when preparing your tax return. Also, because of tax law compliance, the accurate record keeping helps ensure that you comply with tax laws, which can help you to avoid penalties, interest, and other consequences from the IRS. It also helps with efficient preparation. The accurate record keeping makes it easier and more efficient to prepare your tax return. And when you have accurate records, you can quickly find the information you need to complete your return, and you can be confident that you have reported all of your income and deductions. If you are audited by the IRS, the accurate record keeping will help you prove your income and deductions and provide evidence of your compliance with tax laws. In terms of refunds, the accurate record keeping can help you claim any deductions or credits that you are entitled to, which can increase your refund or reduce the amount you owe. To maintain accurate records, it's important to keep receipts, invoices, bank statements, and other records that show your income and deductions. You should also organize these records in a way that makes it easy to find the information you need when you prepare your tax return. It's really important to understand the alternative maximum tax, meaning that that is a separate tax system that runs parallel to the regular tax system and is designed to ensure that taxpayers with high income or certain tax preferences pay a minimum amount of tax. And there are some important points to understand about IMT. Its purpose is designed to ensure that taxpayers with high income of certain tax preferences pay a minimum amount of tax. It is intended to prevent taxpayers from using deductions, credits, and other tax benefits to significantly reduce their tax liability. The AMT is calculated by adding back certain deductions such as state and local taxes and subtracting an exemption amount. The resulting taxable income is then taxed at a flat rate, which is 26% or 28%, depending on the amount of income. The IMT is triggered when a taxpayer's taxable income after adjustments and preference items exceeds the exemption amount. The exemption amount is subject to inflation adjustment and is phased out at higher levels of income. The IMT can have a significant impact of taxpayers as it often results in a higher tax liability. The taxpayers who are subject to the IMT may also be unable to use certain tax benefits, such as deductions for state and local taxes that are disallowed under the IMT. To avoid or minimize the impact of IMT, it's really important to understand the factors that trigger the IMT, such as high income, certain tax preferences, and deductions for state and local taxes. The taxpayers should also consider strategies such as timing the recognition of income or accelerating deductions to minimize the impact of IMT. It's really important to know that IMT can be complex and often requires the assistance of a tax professional to fully understand the impact. If you think you may be subject to IMT, you should consult with a tax professional for guidance.
Capital gains and losses. So capital gains and losses are an important factor when preparing your taxes. A capital gain is the profit that results from selling an asset for more than its purchase price. Capital gains are taxed as either long or short-term income, depending on how long the asset was held. Long-term capital gains, which result from assets held for more than 1 year, are generally held at a lower tax rate than short-term capital gains, which are assets held for a year or less. Capital loss is a capital loss is the result of selling an asset less than its purchase price. Capital losses can be used to offset capital gains, and if they exceed capital gains, they can be used to offset up to $3,000 of other taxable income. Any unused capital losses can be forwarded to future tax years. The basis of an asset is its cost, which is used to calculate gains and losses. The basis of any asset may be increased by various factors such as improvements, and it may be reduced by certain deductions such as depreciation. Realized versus unrealized gains. A realized gain or loss occurs when an asset is sold. An unrealized gain or loss is a paper gain or loss that occurs when the value of an asset increases or decreases but has not been sold. Unrealized gains and losses are not taxed until they are realized. Tax planning can help minimize the impact of capital gains and losses on your tax liability. For example, by carefully timing the sale of assets and taking advantage of tax loss harvesting, you may be able to minimize your tax liability. Additionally, holding assets for longer periods of time may result in lower tax rates on long-term capital gains. It is important to note that tax rules for capital gains and losses can be complex and often require the assistance of a tax professional to fully understand. Dealing with retirement accounts. Retirement accounts are an important factor to consider when preparing your taxes. Retirement accounts such as traditional IRAs and employer-sponsored plans such as 401ks can have a significant impact on your tax liability. Here are some important points to understand about retirement accounts and taxes. Contributions to traditional IRAs can be tax deductible, while contributions to Roth IRAs are made with after-tax dollars and are not tax deductible. Employer-sponsored plans such as 401ks may offer pre-tax contribution options, which reduce your taxable income in the year you make the contribution. Distributions from traditional IRAs are taxed as ordinary income, while qualified distributions from Roth IRAs are tax-free. Distributions from employer-sponsored plans such as 401ks are taxed as ordinary income. Required minimum distributions are mandatory distributions that must be taken from traditional IRAs and employer-sponsored plans once you reach the age of 72, or 70 and a half if you were born before July 1st of 1949. RMDs are taxed as ordinary income. Rollovers allow you to transfer funds from one retirement account to another without incurring taxes or penalties. There are certain rules and restrictions that must be followed in order to ensure a rollover is done correctly. Withdrawals from retirement accounts before the age of 59 and a half may be subject to a 10% early withdrawal penalty in addition to ordinary income taxes. A conversion allows you to change your traditional IRA to a Roth IRA, which may provide tax benefits in the future. However, conversions are subject to taxes if they are in the year they are made. And first-time home buyers may be able to take a tax reduction of up to $10,000 to an IRA to purchase. Self-employment taxes refer to the taxes that self-employed individuals must pay on their self-employment income. If you are self-employed, it's important to understand self-employment taxes you may be required to pay. Some points to consider when it comes to self-employment taxes are self-employment income, which is any income you earn from a sole proprietorship, partnership, or as an independent contractor. The self-employment tax rate for 2021 was 15.3%, which includes both employer and employee portions of Social Security and Medicare taxes. You can deduct half of your self-employment tax on your tax return as an adjustment to income. This reduces your taxable income and therefore your overall tax liability. Self-employed individuals are generally required to make estimated tax payments throughout the year to avoid underpayment penalties. Business expenses incurred as part of your self-employment activity are generally tax deductible, reducing your taxable self-employment income. Accurate record keeping is critical for self-employed individuals in order to accurately calculate self-employment income and deductible expenses. Self-employment income must be reported on Schedule C, Form 1040, if you have a sole proprietorship, or Schedule E, Form 1040, if you have a partnership or an independent contractor. Home office deductions, which is a deduction that allows individuals to use a portion of their home for business purposes. Some important tips to consider when it comes to home office deductions would be eligibility. And to be eligible for the home office deduction, you must regularly use a portion of your home exclusively for business purposes. This means that the space must be used only for business and not for personal purposes. The home office deduction is available to individuals who work from the home, as well as self-employed individuals, freelancers, or remote employees. The amount of the home office deduction is based on the percentage of your home that is used for business. For example, if their office takes up to 10% of the total square footage in your house, you can deduct 10% of certain home-related expenses such as mortgage, interest, property taxes, and insurance. The home office deduction can be used to offset expenses such as mortgage, interest, property taxes, insurance, utilities, repairs, and depreciation. Accurate record keeping is critical for individuals claiming the home office deduction, as the IRS requires documentation of the calculation of the deductions and expenses being claimed. There are limits to the home office deduction, and it may not be available to individuals who are employees and do not operate a home-based business. It is important to note that the home office deduction is a complex tax division and is recommended that if you're not sure what to do, please consult with a tax professional. The child and dependent care tax credit is a tax credit available to individuals who pay for the care of qualifying individual, such as a child under the age of 13, a disabled spouse, or a dependent, so that the individual can work or look for work. Some important points to consider when it comes to the child independent care tax credit is eligibility. To be eligible for the child and dependent care tax credit, the individual must have earned income and must have paid to care for a qualifying individual. The individual must also provide the caregiver's name, address, and taxpayer identification number. The maximum amount of expenses that can be claimed for the child independent care tax credit is $3,000 for one qualifying individual or $6,000 for two or more qualifying individuals. The credit amount is a percentage of the expenses paid for the care of a qualifying individual, with the percentage varying based on the individual's income. The maximum credit amount is 35% of the expenses paid for the care of one qualifying individual, or up to $3,000, whichever is less. Qualifying expenses for the care and dependent care tax credit include payments such as made to a caregiver, such as a daycare center, babysitter, or relative taking care of the individual. Accurate record keeping is critical for individuals claiming the child independent tax credit, such as the IRS requires documentation of the expenses being claimed, so the caregiver's name, address, and taxpayer identification number. The child and dependent tax care credit is subject to certain limitation. The phase-outs may not be available to individuals who are married but filing separately, or who have modified adjusted gross income above certain levels.
For understanding the Earned Income Tax Credit is a federal tax credit designed to provide financial support to low to moderate income individuals and families. And some important points to consider when it comes to this is eligibility. To be eligible for it, individuals must have earned income from employment, self-employment, or from work. They must also have a valid social security number and must be a qualifying child of another individual. And this has a specific income limit, and the credit amount varies based on the individual's income and the number of qualifying children they have. Individuals with no qualifying children and lower incomes will receive a smaller credit, while individuals with higher incomes and multiple qualifying children will receive a larger credit. The maximum credit amount is $6,728 for individuals with 3 or more qualifying children, $5,728 for individuals with 2 qualifying children, $3,584 for individuals with 1 qualifying child, and $538 for individuals with no qualifying children. A qualifying child for this must be under the age of 19 or under the age of 24 if a full-time student, and must live with the individual for more than half of the year. In terms of record keeping, the accurate record keeping is critical for individuals claiming this, as the IRS requires documentation of income, expenses, and the social security numbers of all the qualifying children. There are other considerations as well. This is subject to, for example, it's subject to certain limitations and phase outs, and it might not be available to individuals who have modified adjusted gross income above certain levels. It's really important to note that this is a complex tax provision, and it is recommended that individuals consult with a tax professional to determine their eligibility and the amount of the credit they can claim. Additionally, some individuals who claim these may be eligible for other tax benefits, such as the child tax credit or the additional child tax credit.
All right, and I will now talk about understanding the tax laws. So understanding the tax laws is an important aspect of tax preparation. Now, some key points to note here are that the tax laws are constantly changing, and they're consistently being updated and revised. So it is very important to stay informed of any changes that may affect your tax situation. And it is also to have a good understanding of the tax code to know what deductions, credits, and even other benefits you may be eligible for. Seek professional help. Tax laws can be complex. And if you are unsure about a particular tax law that applies to your situation, best advice is to see a tax professional or use a tax software. File on time. Very, very important. It is very important because if you don't do that, it can result in late filing penalties and interest charges, which means more money out of your pocket. So file on time. And tax planning, it does involve anticipating and minimizing your tax liability by making smart financial decisions throughout the year. And you always want to make sure you keep accurate records of everything you spend. It also becomes very essential when preparing your taxes. It can help you claim all eligible deductions and credits and avoid errors on your tax returns. And know the tax deadlines and also the tax implications of life events. For the deadlines, it is very important that you do not miss, because if you do, again, penalties and interest charges. So let's now go to the tax deadline. Speaking of that, we'll talk about that actually. So again, it is very important to be aware of the tax deadlines to avoid penalties and interest charges so you don't have to spend more money or give more money to the IRS. So January 1st, obviously the new year, is the start of the tax year. This is the date that most tax-related items, such as income and expenses, begin to occur. April 15th, which is coming up very soon, about a month from now. That'll be a crazy day, I will tell you that. The deadline for filing federal income tax returns for individuals. This also is the deadline for making tax payments unless an extension has been granted. On June 15th, the deadline for filing tax extension for individuals. This extension provides an additional 6 months to file your tax returns. So in reality, that basically will give you till December 15th of that year to file your taxes. September 15th, the deadline for individuals who have been granted a tax extension to file their tax returns. January 15th of the next year is the deadline for individuals to make estimated tax payments for the previous tax year. February 28th, the deadline for businesses to file their W-2s with their Social Security Administration, and March 15th, the deadline for corporations to file their tax returns. And it keeps going over and over and over again, like a life cycle. It just keeps going in a circle. Keeps going in a circle. Yay. So you're probably asking something, well, how can I file for an extension? Well, filing an extension allows taxpayers to request
That's my slide.
I'm sorry, I was on a roll there.
But thank you. Filing an extension allows taxpayers to request additional time to file their tax return. An extension gives individuals an extra 6 months to file, but it does not extend the time to pay any taxes that are owed. And some of the steps to file a tax extension are to complete the form 4,868, submit that form, and then pay any taxes that are owed. You need to file your tax return by the extended deadline. The extended deadline for individuals is October 15th, and you need to make sure to complete your tax return by this date to avoid additional penalties and interest charges. It's really important to note that an extension of time to file is not an extension of the time you need to pay. If you owe taxes, you must pay them by the original tax filing deadline to avoid any penalties and interest charges. For this form, it's really important to know several points and to keep them in mind when filling out this form. Its purpose is used to request an extension of time to file your federal income tax return. Also, the form must be submitted by the tax filing deadline to request the extension. An extension of time to file your tax return does not extend the time you need to pay, as mentioned before. If you owe taxes, you must pay them by the original tax filing deadline. And it's really important that you file this form either electronically or by mail. The extended deadline for individuals is October 15. You must file your tax return by this date to avoid any additional penalties. Make sure that the information you put there is correct, including your name, social security number, and estimated tax liability. And this form must be signed as well. And then by completing and submitting this form, you can request an extension of time to file your federal income tax return. And you need to keep in mind that an extension of time is not, again, an extension that you need to pay. So you need to make sure that you pay any taxes that are owed by the original tax filing deadline.
All right, we are in the home stretch here, everybody, so hold on. So let's talk about some common tax filing mistakes, because in life, we always do make mistakes in life, and they do happen. So some of them include the following: incorrect social security number. Make sure your social security number is for you, your spouse, and dependents are correct. Math errors. I know taxes are not the greatest thing in the world, and you just want to rush through them and just get them done and over with. I know there's some people out there that want to do that, but it is very, very important when you are doing your taxes to double check your math. Double check. Incomplete information, neglecting to sign the date in return. If filing a joint return, both spouses must sign. And even incorrect filing status, it could affect your tax liability. Forgetting to include all income. Make sure you report all your income. Missing deductions and credits. Don't overlook the deductions and credits that you may be eligible for, such as, like we talked about earlier today, the mortgage interest deduction and the child tax credit. Neglecting to report self-employment income. If you are self-employed, make sure to report all those self-employment income expenses. Incorrectly reporting tips. Tips are taxable income. They must be reported. And neglecting to report gambling winnings. Gambling winnings are taxable income, and they must be reported. Must be. And let's make sure that none of us here in this room or on Zoom are going to, get a tax scam. And for those who do not know what that means, it's basically tax scams can be costly and damaging. So it is important to be aware of potential risk and to take steps for yourself. So here's our advice. Don't trust unsolicited calls. If you're receiving a call from someone claiming to be the IRS, hang up the phone, block the number. The IRS will not ever, and I mean ever, call you unless you have previously spoken to them or initiated contact. Don't click on suspicious emails. It's kind of basic stuff to know. Don't click on those. Verify the identity of your tax professional. Make sure you're working with a reputable tax professional if you decide to hand your taxes off to a tax professional. Don't share your personal information. Be cautious. Be cautious of sharing that info. Be wary of phishing scams. And they're often disguised as emails or phone calls from the IRS or other tax authorities and may be requesting your personal information. And our advice, use secure websites for e-filing. When you e-file, make sure you use a secure website and don't enter any sensitive information on a public Wi-Fi network. That's why we have VPNs out there. Use that. And don't fall for the quick refund scams. Be wary of taxpayers who promise large refunds in exchange for a fee. This is a common tactic used by fraudulent taxpayers. So in summary of all the things we talked about today, let's sum this all up. Filing your taxes is an important process that can impact your financial stability and well-being. It can help you determine your filing status, be able to gather the necessary paperwork we talked about, be able to know what is tax deductible, make sure you file by the deadline. If you feel like you can't do your tax return, you can always hire a professional or use a tax software like TurboTax. You want to make sure you have accurate record keeping at all times and be aware of the tax scams. So does anyone have any questions? I know we went over a lot of stuff today. Does anyone have any questions about taxes, filing taxes? Again, if everyone does want this slide deck, I will send it to you if you want it. Once, twice. I guess we did our job then. I guess we teach you guys real well then. All right, I'll leave this up there for the QR code for attendance. Just to go over for the rest of March, we will not be meeting for the next 2 weeks. Obviously, next week, spring break, so we're not meeting. And then the following week, we will not be meeting because the e-board will be having a meeting. So basically, general members and candidates, we will not be meeting. However, though, we will be having a meeting at the end of the month on the 27th, which I can now announce this, that BAP New Sigma will be co-hosting with the Student Management Investment Fund, UBS. Thomas Kanagati will be coming to speak to us. The first half will be SMEF related. Second half will be BAP related. So we are very, very excited about that. So again, please invite all your friends to come out to that meeting. I know it was a lot of information we had to talk to you guys about today, but again, it was all worth it because now you know how to file your taxes. Now you know. But if that's all it, if you guys have any questions, you guys come up to me or see one of our awesome e-board members. And with that being said, that's it. Enjoy the rest of your day and have a happy and healthy and safe spring break. And we'll see you back here in 3 weeks for UBS. Thank you.
I'm going.
Thank you.
Bye.
Thanks, everyone.
Of course. Have a nice day. Goodbye.
Bye-bye.